Lots of people hate the idea of investing money because they always feel that every time you invest some money into the markets always go down and you always lose money. But not anymore. Because in this video, I want to go over what I call the investment trio, which is if you want to be able to find a good investment opportunity, there are three things that you want to pay attention to. And that is number one, how to be financially prepared. Number two, how to be financially educated. And number three, how to stay ahead of financial trends. Now, of course, I gotta give you the disclaimer, which is that investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But what I'm talking about here is how do you identify a good investment opportunity? And in order for you to actually capitalize on that, the first thing you gotta do is be financially prepared. If you don't have any money to go out and invest, it doesn't matter what's going on in the markets. It doesn't matter if you found an amazing investment opportunity tomorrow. If the stock market glitched tomorrow and you could buy any stock you wanted for 90% off, but you have no money to invest because all of your money is going to pay off your credit card bills, well, that doesn't do you any good because now you don't have the money to actually take advantage of that opportunity. That's why the very first thing you gotta do is you gotta be financially prepared. More specifically, what that means is before you worry about even investing your money, what you gotta do is save $2,000. If you don't have $2,000 sitting in your bank, not there to go out and buy something, but there to protect you against an emergency. This is an extra $2,000 that you don't need to pay your bills. If you don't have $2,000 saved up, you are in what I call the danger zones because right now, if you run into any little bit of an emergency, well, now you got to go into credit card debt to fix that emergency. And so you're living in this, what I call financial danger zone. So you got to go out and save $2,000 as fast as possible. And if you don't have $2,000 saved up, you got to stop eating at restaurants. You got to stop going on vacations. You got to stop buying the Gucci and the Louis Vuitton. Get yourself this $2,000 ASAP. After you do that, the second thing you got to do is I want you to pay off your credit card debts, your high interest debts. Again, you want to do this before you go out and start worrying about investing your money because the average APR on credit card debt at the time of me recording this video is around 24%. But historically, the stock market has grown by around 10% a year on average over the last century. Now let's do a little bit of quick math. 24% is bigger than 10%, which means if you can pay off your credit card debt 1 year early, not only do you get a guaranteed rate of return, but it's even a higher rate of return than the average stock market return. If you go and invest your money into the stock market or anywhere, you might get a 10% return. Maybe you get a 20% return, but maybe you get a 2% return. Maybe you get a minus 5% return because we know that market crashes happen. We know that recessions happen. We know that there are some years where the markets go down. Just because the markets have averaged 10% a year does not mean that it goes up every single year. In fact, what it looks like is kind of like this, where you have these jagged bumps. Over the long term, the market has gone up, but it goes up and down and up and down and up and down along the way. And so if you have these high interest debts, what I want you to do is not put your money into the markets right now. Use your money to pay off the high interest debts as fast as possible. Until you do these two things, you are in what I call the financial danger zone. And what I say is when you have these two things not done, if you don't have $2,000, if you still have credit card debt, what I say is you gotta cancel your Netflix subscription because you cannot afford it. Now you might say, well, Jaspreet, it's only $10 or $12 or $15 a month or whatever it is. Well, it's not the $15 a month. It's the 2 hours a day you're spending binging Netflix when you should be learning, when you should be reading books, when you should be figuring out how you can earn some more money. Because right now, you got to save this $2,000 and pay off your credit card debt because you can't even think about investing your money until you get out of these shackles, until you get out of the financial danger zone. Once you do these two things, the next part of being financially prepared is to systemize your money. That means have a system where every time you get paid, some of your money is being put aside to be invested, some of your money is being put aside to be saved, and then you spend whatever's left. See, the majority of people, the problem for the majority of people is they make money, they spend their money, right? You pay your rent, you pay your mortgage, you pay your car payment, you pay for your groceries, you pay for the Gucci, you pay for the Cancun. Maybe you even don't have all the fancy stuff, but then you spend all your money and then you have no money left over and then you have no money to invest, you have no money to save. And so if you saw an amazing investment opportunity tomorrow, if the stock market glitched tomorrow and you could buy whatever investment you want at a huge discount, it doesn't do you any good because you have no money to invest. This is where I want you to start being smarter with your money because you want to start preparing when times are okay. That way you can take advantage of big opportunities when times are not okay. And a simple way that you can do this is by following something like a 75, 15, 10 plan, which says from here on out, For every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you are putting aside to invest or that you're investing. 10 cents is the minimum that you're saving. This way now you're always paying yourself first. And by paying yourself first, I mean building your wealth first, because this is where your wealth is built, your investment money. This is where your protection is built, your savings money. And I gotta clarify, this is not savings to buy a car or to buy a home. This is savings to protect you against an emergency. This is there to protect you. This is there to build your wealth. This is there to make you look rich, right? This is the money you spend on Gucci. This is the money you spend on your clothes. This is the money you spend on your car. This is the money you spend on your food. This is the money you spend. Most people are fake rich. That is, they have all the nice stuff, but they have no real assets. But if you have the Gucci, if you have a Rolex, if you're going on fancy vacations, but you don't have an investment portfolio, if you don't have any dividends, if you don't have any royalties, if you don't have any rental income, you are hustling the wrong way. You're showing off all this stuff, but you have no real wealth for yourself. And what I want you to do from here on out is I want you to make yourself rich first. You don't have to get all fancy and complicated. Just open 3 different bank accounts. Every time you get paid, put some money into your savings account, that way you don't spend it. Put some money into your investment account or automatically invest it, and then spend whatever is left. That's the difference between wealthy people and everybody else. Is wealthy people spend what's left. Everybody else spends their money and then they invest if there's any money left over, but no more, because now you're going to be financially prepared. Now we can take advantage of investment opportunities, and so you can just invest your money. It depends on what your strategy is, but at least now you have money to invest. Once you build this financial preparedness, the second thing that you want to do is build your financial education, which is how do you actually analyze your investments. This financial education is not something you're going to get just from one YouTube video. I have a lot of videos on this, but this is where you want to start reading books, you want to start taking classes, you want to watch more content on this, because there's a lot that goes into actually analyzing your investments. But let me give you a high-level overview, because if you had to make a decision of what is a cheaper investment, what is a better deal? Is it investing in Walmart at $78 a share, or is it investing in Amazon at $180 a share? Many times the analysis that many people make is, Walmart's shares are $78, which is cheaper than the $180 that Amazon is, so Walmart is a cheaper stock. It's a cheaper company. But that is a completely wrong and horrible and just not how you do that analysis. Because your share price, if you look at a stock, if you go out and buy one share of Walmart, you become one of the owners of the Walmart company. If you buy one share of Amazon, you become one of the owners of Amazon. That's the beauty of the stock market. But the problem is most people now are investing in stocks with no idea of what they're buying, or if it's expensive or inexpensive. And this is where you want to dig a little bit deeper, because the share price gives you no indication. It gives you no education of what's actually happening inside of the company, because the share price is really just the price of the company divided by how many shares are out there. And so think of it like a pizza. If you have 8 slices of a pizza, one slice is 1/8 of the pizza. But if you divide the pizza into 16 slices, now if you have one slice or one share, it's 1/16 of the pizza. So creating more shares just decreases the share price, but it doesn't actually mean you own more of the company. So let's dig a little bit deeper. At the time of me recording this video, the Walmart company, the corporation, is worth around $630 billion, and the Amazon corporation is worth around $1.8 trillion. This is all public information because these stocks are trading every second when the stock market is open. So if you go to any stock research website, you can see what the market capitalization is, meaning what the total worth of the company is. That means hypothetically, if you wanted to buy the entire Amazon company, you could do it hypothetically for $1.8 trillion. If you wanted to buy the entire Walmart company, you could do it hypothetically for $630 billion. That's how much all the shares are worth. But again, if you're just looking at how much this company is worth, it doesn't tell you that much. Is that expensive or is it not expensive? And so now, if you've ever seen Shark Tank before, you might have noticed that the sharks say, I am willing to buy your company for 5 times earnings, 5 times profits. That's kind of one analysis that you could think about doing when you're investing in stocks, because it gives you an idea of, is this company completely overvalued or undervalued? So let's take a look at how much money these companies made in 2023. I did a quick Google search, and what I saw is that in 2023, Walmart made $31.3 billion in EBITDA, and Amazon made $85.5 billion in EBITDA. By the way, EBITDA is just a fancy financial term for earnings, or profit, or net income. There's a lot of different ways to say it. It's just one fancy accounting term. And so now we can do a little bit of math, because if Amazon earned $85.5 billion in 2023, and they're trading at $1.8 trillion of valuation, what we can do is take the market capitalization, or $1.8 trillion, divided by how much money they made in 2023, which is $85.5 billion. And now I know that Amazon is trading for around 22 times earnings. That's the earnings multiple based off of these numbers. At the same time, Walmart, if I take the $630 billion of worth, market capitalization, and I divide that by how much money they made in 2023, that tells me that Walmart is trading for around 20 times earnings. That means Walmart is actually a little bit cheaper than Amazon based off of the 2023 EBITDA, the 2023 earnings, and how much the market capitalization is today. Again, this doesn't mean that you want to go out and invest in Walmart or Amazon based off of this, but it starts your research, which shows you that your financial education has a lot to do with understanding how do you actually analyze your investments. These are the types of things you want to think about, which is a little bit deeper than just how much is this company trading for, which is why I want you to be investing in your own financial education as well. Then the third part to this investment trio is what I call understanding the financial trends, which is understanding where the money is moving, because you want to be investing your money into an industry where the money is moving into, not where the money is moving out of. Because you want to invest in an industry that is going to be worth a lot more money in 5 years or 10 years than today. But now the question is, well, how do you actually analyze these types of financial trends? And this is one of my favorite parts. It's studying what's happening in the markets. Now, there's no secret sauce to how you can do this. This is studying things like, where are consumers spending more money? Like, are there changes in habits that are causing people to spend more money? Is it a change in regulations? Are laws changing which have made certain businesses benefit? Are there new innovations that have come out which have created new opportunities for businesses to make more money? Or are there shifts in how angel investors or venture capital investors, early stage company investors are investing their money? Because that can also show you new financial trends. So what you want to look for are these types of trends. And let me just give you a couple examples to get your brain jogging of what this looks like. But I got to give you another disclaimer. I'm not telling you what to invest in. This is just some research that my company Briefs Media did, because we publish a weekly report called Market Briefs Pro, where every week my team is publishing these types of financial trends. Again, we're not telling you what to invest in. We're providing that financial research to be a foundation for your investment knowledge. So let's go through a couple examples just so you kind of get an idea of what this looks like. So this is some data and some charts that we published in Market Briefs Pro, and what we saw is that obesity has been rising in the United States steadily, along with diabetes, which has been rising steadily in the United States and across the world. With this rise of obesity and diabetes have come more FDA-approved weight loss drugs, which of course means that certain companies are making more money. For example, we can see companies like Eli Lilly, who has a big presence in the diabetes market and the diabetes drugs market, have made a lot of money through this increase in people who have diabetes. Again, this is kind of a short synopsis of things you want to be thinking about when you're researching financial trends. Is you want to see what is causing money to move into new industries. We see that more people are gaining weight, more people are having diabetes, which have led to new innovations and intellectual properties, which have led to some companies making more money. Let me give you one more example so you can kind of think through the things that I'm talking about. This is another report that we published in Market Briefs Pro, and what you can see is that sports betting has become legal in more states across the United States over the last number of years, which has led to the revenue from sports betting, legal sports betting, to explode over the last 5 years. And of course, there are certain companies which have attracted larger market share than others, which has created, again, a new financial trend. Now, the goal here isn't just to find a random trend and dump your money into a company in that trend. It's to identify a financial trend that you agree with, that aligns with your morals, that is legally feasible, that's financially feasible, and then to make an educated decision, to analyze those investments, study that investment. Does it make financial sense? Is it undervalued? Is it overvalued? Study the financial statements, and then make sure you're financially prepared to capitalize on that investment. That's what makes a good investment opportunity. Now, for those of you that are wondering, yes, you can join Market Briefs Pro. There is a cost to join it. However, because you're watching this video, you also have the opportunity to get a free trial to try it out for yourself. So if you want to try out Market Briefs Pro with a free trial, you can try it out for 10 days. I got the link for you to join down in the description below. If you like it, after the free trial, it's $37 a month after that. But if you don't like it, well, you don't lose anything because you can try it out for free with the free trial. So if you want to check it out, I got that link for you down in the description. But this is where if you want to identify good investment opportunities, you want to pay attention to all these three things. And then one part that I did not mention that you have to understand is you want to be a long-term investor. That's the key here. I can't tell you how many times I hear people say, oh, I threw my money into an investment and then the markets go down the next day. Well, guess what? Markets go up and markets go down. That's one thing that markets will always do. In fact, let's take a look at this one more time. How do markets move? Well, over the last 100 years, we've kind of seen markets move like this. Yes, over the last 100 years, markets have gone up overall, but you can see there are market crashes, there are recessions, there are dips, there are corrections. That is a part of the system. Nothing will go straight up forever. And so when you are investing, you got to remember that your goal is to be a long-term investor. I am not a trader. I don't understand how trading works. Trading is a very different game. Nothing that I'm talking about has to do with trading. What we're talking about is investing for the long term, owning good companies, owning good investments for the long term, which is years or even decades, because that allows your investment to really compound and grow. That's where the real wealth is, and that means you have to understand the psychology of investing, which is markets go up, markets go down. But over the long term, we have seen the economy grow, we have seen the stock market grow. Over the long term. Have we seen recessions? You bet. We saw a recession in 2020. We saw a recession in 2008. We saw a recession in 2000. We've seen a recession every decade for the last century. Yet, markets have gone up despite that. Yet, these downturns have built more wealth than anything else because they create buying opportunities. But that requires you to be financially prepared, be financially educated, and be able to capitalize on the financial trends. You are 25 years old right now. You go out and you put $8,000 down to get yourself a brand new BMW because everybody's got a nice BMW nowadays. And now you got these expensive car payments that you're going to be paying for the next number of years. Now, after 5 years to pay off the car, and you might think that you're going to be car payment free, but what ends up happening to everybody in this situation